We start off with the news that sent stocks to another set of record highs today. Pfizer announcing its COVID pill cuts the risk of hospitalization or death by nearly 90%. The news prompting former FDA Commissioner Scott Gottlieb to say this.
I think the bottom line is the end of the pandemic, at least as it relates to the United States, is in sight right now, given all the tools we have to combat this disease.
Reopening stocks certainly seem to agree with that the end of the pandemic is in sight. Cruise lines, airlines, casino stocks all rallying in a big way today. So is this the green light for the markets? Is this why we were able to set yet another set of records ahead of the weekend, Guy?
Hey, Melton, there are only green lights for the markets. It's amazing. I tell you what got me by surprise today. You know, things that make you go hum. I think that was an MC Hammer song. The fact that we had all the rhetoric out of the Fed this week. We had what was, I thought, a fantastic job numbers. Oh, by the way, this news out of Pfizer. If you had told me that 2 days ago, I'd have said 10-year yield is going to be 175 at least, if not higher. And here we are trading down 8 basis points to 145. So the way I look at this, you buy the banks on weakness, specifically Citi, and you mentioned casinos. I just still think Las Vegas Sands is way too cheap here. So I think LVS has a lot of room to the upside. But the move in the bond market today, off of everything you just said and what we heard this week, is fascinating.
To say that the 10-year yield would end the week at 147, Jeff Mills is, I think, a prediction that no one on this show would have made given all the events that were scheduled for this week.
No, and considering the data that came out, and I think it's a little bit inconsistent with what we're seeing elsewhere. I do agree with Guy, though. I think in terms of the banks and some of the other reopenings that may be tied to the yield curve, you know, ultimately I think Powell gets renominated. I think him being in that seat then continues to perpetuate some of the dovishness that he's had over the past number of months. And I think the short end of the curve comes down, the curve steepens, and that's a good thing. But we had jobs growth. We're seeing consumer credit go up. So even as some of this fiscal stimulus fades, you're getting spending that is continuing, so demand from the consumer. If you just look in the market, for example, so discretionary versus staples on an equal weighted basis, continuing to make new highs. Small caps now breaking out of a 9-month range. I mean, this is the market telling us that the economy is going to continue to grow. We're past this growth scare from the second and third quarter. And we saw some big moves in names today. They're going to benefit from that. We've had consumer spending on goods way above trend and services way below trend. So I think the Pfizer news, just along with the natural progression of the reopening, is going to be a good thing for those services to recover. So Live Nation, just as an example, this is a stock where supply is not an issue. You have twice as many artists that are going to tour in 2022 than they would before the pandemic. So when you talk about demand and supply not being be able to meet that, this is an industry where that is not a problem. So I think stocks like Live Nation, Expedia had good numbers. That's going to be the trade here for a little while. I've mentioned that I think there's a shot clock on that trade, but I don't think it's until you get into 2022.
And kudos to Karen Feinerman, who's been in that Live Nation trade for some time now. So Nadine, what gives? Is the bond market right? Or I mean, it doesn't make any sense. If we are really poised for this sort of rapid expansion and this continued growth, et cetera, everything coming up roses here, then why are we at 145?
Well, sometimes what happens when things go up, they come down. So you had yields go up a bit and down a little bit. You had energy up, it softened a bit. But I look at that as an opportunity. You got some gifts. So heading in today, you saw implied volatility premium on crude oil. So look at the USO at over 47%. And when you look at that, what does it mean is people are buying protection. They're worried about it. So if you think the world's reopening, if you think Expedia is going to be hot and cruise lines and people are going to be going to Disney sites, you're going to want to own energy. And so you got a gift this morning coming into the day. Similar thing with treasuries. So when you see yields that low, that lets you short treasuries because you know they cannot stay that low. If the economy is going to be heating up, which, you know, look at Live Nation, all the things we're talking about here, and a lot of the positive reports today, you're going to see long end creep back up. So I looked at it as a little bit more of a gift. So on a day when you'd be trimming things that popped, you also hopefully can find opportunities to add to the long side or the short side, and we found some of those today.
So the translation that I come away with from what Nadine said is that the bond market is actually wrong. So, Steve Grasso, would you be in that camp as well?
You could never say the market is wrong. Whenever you say investors got this wrong or analysts got this wrong, you always are sort of barking up the wrong tree. I think what the outcome that we've all seemed to start to become familiar with is that positioning in the bond market has made it so that rates are going nowhere. So what I mean by that is, guys, we're short treasuries, so they have to cover now. If they cover, then that puts a lid onto the rate scene. But, this has been a problem for as long as Chairman Powell has been in that seat. He was perplexed why there was no inflation. So we probably all shouldn't be so perplexed why we're more like Japan than we'd like to admit we are, and it's a global environment. So once China comes back on the scene, it's very hard to have any sort of inflation because we ship it back and forth overseas. So I think this is kudos to Tom Lee. This is an everything rally. I had thought it was just going to be cyclicals and value, but it's truly going to be everything going into year end and then some.
Okay, so if positioning is completely is offsides, then, and so Guy, that's why you're saying financials, because in theory, the long end should go higher, the yield curve should steepen, and that should be beneficial to financials.
Yeah, and I hear what Steve is saying. By the way, Steve has not wavered on this one iota. I'm just was shocked to see them moving. It made no sense to me, so I'm sort of in Nadine's camp with this one. But the banks are just too cheap. And Citi, which is, listen, I've been wrong on Citi now for a while. I thought Citi would trade up the book. But when Citi trades down to this 85% or so-ish of tangible book, you go back and look, it's historically been a level where you want to buy the stock. So, yes, to answer your question, I think banks on this sell-off, off this bond move, are very interesting.